Meantime, I want to talk a little tech this morning. NASDAQ is the only major average positive on the year, up around 10% since January 1st. Joining us right now with what he likes in the sector, Dan Niles is back. He's founding a partner at AlphaOne Capital Partners. Good morning to you. You just probably heard what Jim said, and we've talked a lot about these stay-at-home stocks. A lot of the tech names are the ones that have worked. What's working, or what do you think still works at this point?
Yeah, I mean, I think, you have to be very selective. The market's obviously had a tremendous run. Valuations for the market are at all-time record highs by some measures, like market cap to GDP. And so the names that we're sort of focused on are ones that still have interesting things in front of them, such as the gaming companies. You've got the first brand new consoles from Microsoft and Sony out this year for the first time in 7 years. So we like Activision, Zynga, Take-Two, names that have done well during this crisis as people stay at home and play video games. I've got two teenage back from college. That's what they like to do for free time. But that's something that's going to continue to accelerate, I think, going forward. I think e-commerce was doing well before the virus, accelerated during the virus. I think that's still going to do well going forward as the viruses are kicking up again. And so we're staying with those, but we have, cut back a lot of our big winners, and we have bought over the last several months names that we thought would recover, and we've added some new names to the portfolio as well. Automotive is one area where auto sales in China, believe it or not, were up in May year over year for the first time since June of 2018. We're adding sectors, things related to copper as well. And so we're kind of doing that, but we're also reshorting a lot of the names that have doubled off the bottom, what we like to call the mock names. So malls, airlines, cruise lines, hotels. We put
You're shorting those now?
Yeah, we put some of those on over the last couple of weeks. We didn't have any, hardly any of those short when the market was bouncing. And we think that those are names that a lot of those names are structurally in trouble, I think, beforehand, like the malls related to, retail stores, et cetera. And the airlines, a lot of them were over-levered. We agree with the Boeing CEO who said earlier that one of the major airlines might go bankrupt this year. And hotels, cruise lines, you've got a lot of companies that have high debt leverage with those companies to stop them from going under, because they solved the liquidity crisis by extending loans basically to all companies. They didn't solve the solvency crisis, though, which means, if we're still sort of shut down 6 months, 9 months from now, these companies are still burning a lot of cash. So we use that to hedge.
And is that your bet? Just Dan, just so I understand, if you're shorting the airlines, are you betting that 6 to 9 months from now we are still shut down?
Well, what I'm betting is that we have a second wave and that you've got companies that are still massively over-leveraged. We're using those names to balance out other names we like. We bought some Facebook, for example, yesterday. We like the fact that the stock went on sale on Friday and then got hit again. This isn't the first ad crisis. So we balance, a Facebook long against a short in the mocks, as we call them, and we think that's a good place to be. And so that's how we're trying to run the portfolio. That's how we've done well so far this year.
Right. I see that you're long Viacom. What's your argument there?
Yeah, that's another one of those names, Andrew, that we bought on the way back up, and it's done obviously really well for us. If you look at Viacom, it was clobbered by the virus, right? Ads pulled way back. We tried to avoid all those related names. We're actually short Disney now as a hedge against that. But with
You're
Viacom,
still short Disney.
Yeah, and so because look at it. Disney's got their park openings pushed out again. If you look at Viacom, the company trades at about a 6 PE. Their ad business got clobbered as well, but they've got a streaming business that's got 13.5 million subs. It's up over 50% year over year. And, they've renegotiated a lot of their contracts with their distributors. So it's a name, again, we have the Viacom long. Would we have it as the size we have it if we weren't for the Disney short? Of course not. But we've got those things matched up. Disney's at a 50 times PE. So I'll take the 6 against the 50. Disney numbers are still coming down. We think Viacom actually can make their numbers. So that's, how we try to run portfolio so we don't worry if the market's up or down.